right, ladies and gentlemen, it's AaronFragnito, your host of the Passive Cash Flow podcast, back again with another episode. And we have a very interesting guest here who I've had on the show years ago, but he was so exciting and he's everywhere. He's on every podcast in the world. He knows all about estate planning and how to protect your assets. Brian Bradley, how are we doing today, Brian?
Doing great, Aaron. Like the pun on the topic, assets, and it's an important topic as always. I'm going to try to keep it not legally dense, and I'm not going to be, I'm not your attorney, legal guru here. We're just going to be talking in generalities on some pretty cool topics. I'd say we'll listen to our first one to really get some meat and potatoes on what we were talking about. We can always recap some of it, but that prior episode would probably be like a really good deep dive to recap, because we're going to talk go into some new stuff today, I think.
Yeah, absolutely. I kind of want to go over some scenarios of kind of our average type of investor and then kind of a higher net worth investor, and get some free legal advice, although I know this is not legal advice, and of course not solicitation for funds, tax advice, or legal advice, but we can kind of talk about, hey, what would this type of person perhaps, how would they structure their estate? What are some tools they might want to have an understanding of to be able to avoid paying as much tax as you legally can? And I also want to talk about the difference between avoiding paying tax legally and also just illegally not paying tax, which of course is not a good estate strategy. But I love having you on the show, Brian, because you've been on how many podcasts have you been on? Have you lost count at this point?
I don't know. I talk a lot, on different investment shows and different summits and
right.
But I just like educating people, and there's a lot of BS that's out there. And you got a lot of air quotes, promoters selling concepts that don't legally work. And then and the sad thing is, when they don't legally work for you as the client, you're the one that generally is on the hook with the IRS or the lawsuit, and then you're losing your money, losing your assets, and then if it has to do with taxes, potentially going to jail.
Mm-hmm, mm-hmm. Yeah, you don't want that. You don't want your foe to be the IRS there. But no, that's really interesting. And that's so important to have on a licensed attorney here that really knows how these things are done, not some guru or some guy selling you, a package of books and CDs. So although you are a guru in this space, but that's kind of a four-lettered word. But no, it's really interesting. So yeah, let's break right into it now, because our last episode years ago was kind of more about LLC structure, kind of overall estate planning in a way. What I want to go through now to have a little fun is kind of give you like an average type of a person that we run across looking to invest in real estate, that often invests in our syndicate, and give a little bit of guidance roughly on how that person might be able to plan their estate to avoid paying as much tax as possible, as legally possible, right? At People's Capital Group, we help you invest in real estate. Build your wealth by owning professionally managed apartment buildings in the northern New Jersey market. We want to show you how owning real estate is attainable, even for the busy professionals that don't have the time or experience investing in real estate. Now, we only work with select people who are serious about building wealth. So find out if you qualify at peoplescapitalgroup.com. So let's just take an example here. Let's say I work in Manhattan. I make $350,000 a year. I have an IRA that I try to max out as much as I can. That's invested mostly with People's Capital Group. Maybe I have a portfolio of stocks and bonds and other real estate assets passively invested that are equal to, say, a $5 million net worth or something like that. Okay. And I'm getting towards the retirement age now. And someone like that, maybe in that income bracket, in that net worth bracket, so you have two kids and a wife, right? And you're age 50. So you're trying to really plan out now, okay, let's say I have, a few million with People's Capital Group and some real estate syndications. I have a few million in stocks here and bonds and, another $250,000 in crypto. Okay. Or something like that, a little diversified portfolio. So how would someone like that, you probably need more information, but go about, planning out their estate essentially?
Yeah. So when you want to think about different buckets that we have there. And the first thing, if you're going to be calling me, is I'm going to be looking at, what's your first priority? Is it tax mitigation or is it asset protection from from risky assets and getting sued and creditors coming after you? Because those are very two distinct things. I think if you're going to weigh one or the other, we have to look at what's your risk profile, what's your job, are you a surgeon? and you're owning all of this, rental property, what are you trying to, are you trying to accumulate more, or are you done investing and now you're kind of just like hold what you have, maybe pay off all of the mortgages of your rental properties and just go pure cash flow? Are you looking for, what's the word I'm looking for? Legacy and passing down your assets.
Yeah.
On there. So, a lot of those add into the factor, but the first starting point is always protect what you have. We can set you up with the greatest tax strategy, individuals and professionals and CPAs and wealth managers, but then if you get sued and lose everything, they have nothing to work their magic on.
Right.
So we're first thing first is looking at your system and say, how's everything titled? Is it in your name? Is it in a revocable living trust? Is it in an asset protection trust? How's this stuff owned? And let's fix that to where if you have a doomsday lawsuit, first things first, we want you to be able to keep what you have.
Right.
Then from there, once we have the system in place of what we're protecting it through, then we can start working with the CPAs and your wealth managers to say, okay, hey, now you work your magic within the systems that we created to protect. And from there, it could be creating, self-directed 401ks or IRAs, or, start trying to decrease your taxable estate, or turning what we use, like you heard on the talk on the last episode, was our hybrid trust. Well, we can turn the hybrid trust into a charitable hybrid trust. So where that way we can use combinations of different types of trust to maximize your goal, but we have to identify what is the goal, how much net worth are we working with? Because if we can take money off the table, which not everybody can, but let's just say, there's this great high set trust, love Jeffrey Verdon, guru of the gurus.
Okay.
Section attorney, but he won't even pick up the phone unless you're worth 100 million or more.
Yeah, me too. So just let's clarify.
Yeah. No, he has this great high set trust called like Have Your Cake and Eat It Too trust. But unless you can afford to take 25 million, off the table of your net worth to put it into this trust to decrease your taxable estate, that's kind of what that trust is for. So there's a lot of different strategies. It really just comes down to what is the client's overall goal. Is it protection? Is it protection and tax mitigation? Then we got to look at what's your risk profile. And then from there, we're looking at how much net worth can we take off the table, but you still have to disclose this stuff to the IRS so that you don't go to jail for it or have to pay the money, back to the IRS for an oops, sorry, we didn't.
Yeah. You don't want to oops with the IRS there. Okay, so you just mentioned a lot of interesting words that I don't think our listeners will know the definition to, because I don't know the definition to them. So I think that unless you're in this business, they're a little complicated. So a hybrid trust. Let's just go over what that is one more time. Yeah.
Yeah, absolutely. So, I always break it down like the key concepts of asset protection. And so you have, we'll just say 3 different layers. Think about winter. When we're talking about winter, we're going out skiing. What are we going to do? We're going to layer up. We're going to put on a base layer, like a, nice skin tight shirt. Then we're going to put on like a merino wool sweater, or for you ladies, a cardigan. And then we're going to have a nice winter-proof, waterproof jacket that's going to keep us nice and warm in the middle of winter. That storm's coming. Yeah. So 3 different layers. Layer number 1, the skin layer. That's your LLCs and insurance. That's when you're just starting out. Second layer, your cardigan or your merino wool sweater. Talking about management companies, limited partnerships, Wyoming LLCs. Some other people use those. Kind of when you hit that 4 units or 4 LLC spot, we need to start consolidating everything, using a management company for, passive tax flow entities. So there's just one tax filing at the end of the year. Then the hybrid trust, that's your 3rd layer. This is your waterproof layer. You're in the middle of Siberia. Your world's falling apart. Doomsday lawsuit. I'm getting sued. Valid case, valid claim, valid lawsuit. I'm going to lose. How do I still keep my assets? My LLCs are getting pierced. My world's falling apart, but I don't want to lose everything. That's where a hybrid bridge trust comes into play. And what a hybrid trust is, it's a foreign Cook Islands trust. So the strongest trust in the world for the last 40 years, supported through case law up to the Supreme Court. But instead of having to pay an astronomical costs on the setups and then the tax disclosures, 1035s, 1035As, FACTA disclosures, and all these insane IRS disclosures that you have to do for foreign accounts, we take that foreign trust and domesticate it through the IRS to make it easier to manage, no more disclosures. So everything's legitimized through the IRS. It's a hybrid in that it is a foreign Cook Island trust. It's just domesticated for tax purposes until, God forbid, I ever have to what's called break the bridge and turn that domesticated trust into a foreign trust. And that's where you kind of have your cake and eat it too with that trust. I have the strength of the Cook Island power, just domesticated for IRS purposes and ease of use. Then if I ever need it, I have the tool in my toolbox. Now I can just crash that bridge and I am what I am, a foreign trust now.
Oh, okay. All right. So when you're about to lose the suit, you could like switch it quickly over to a real foreign trust. Okay.
Correct. So what we do is just breaking a bridge it's an IRS classification. So we remove you as the main trustee. It's still your trust. You're still the beneficiary of it. You're still the creator of it.
Yeah.
It's just by removing you as the trustee, we now break the IRS compliance prongs. And now you are what you are. You're just a foreign trust, no longer domesticated in the
Okay. Interesting. So that's a really interesting setup. So there's so many different ways to protect your assets there. Now, at what point does it make sense wealth wise to do the Cook Islands, a hybrid trust there where, you got a guy who's got 25 million, let's pick up the phone. But could you be maybe it's someone with $5 million of net worth?
It would be higher, right? You would think, oh, I'm not that important. I'm just, your nurse or cop who got some rental properties and this is not retirement. The actual main client profile is around 1.2 million of net worth. So equity, not saying my total value of all of my properties in my house is 1.2 million. We're looking at equity value, unprotected assets. So I'm taking out your 401k because those are ERISA protected. They're exempt. And then I'm taking out IRAs because most states have very, very strong state exemptions for your IRAs. So I'm taking that out of the equation. And so what I'm looking at is how much equity in your primary, how much equity in, syndications, if you're investing in syndications, do you have cash value in your bank account, and then your rental properties. If you invest in businesses and you have, 5% shares or whatever, or your personal brokerage account, they're not exempt. So if you have millions of dollars in your stock portfolio, well, that's fair game to be collected on. So we got to protect that.
Right.
So we got to then create the proper buckets, put them into a management company for legacy protection and passing it off once you die. We want to make sure you have a nice segue into who gets what, and then you cap it off with a very, very strong trust. So generally you're looking at 1.2 million is the proper starting range of net worth. Yeah. And the reason for this is, let's say you come to me late, and this happens. Sometimes I have people come to me with 20 properties, all in their personal name over 20 years.
Oh gosh.
You imagine how much work I have to do to clean this up. So then the costs get so astronomical that it's just too expensive. So then they do nothing and then leave everything on the table.
Yeah.
Or their CPAs mess this stuff up. And I get this call probably once a week, is their CPA 15 years ago created an S Corp for real estate, and they put 50 properties in one S Corp. And now you think of all that growth with all that deferred taxation over all that time.
Right.
And now they realize, like, oh my God, this is really bad. I have $50 million worth of equity and properties in one LLC taxed as an S Corp or an S Corp. I have to take it out because we have to split it up. Most people don't have the money to pay back to the IRS for the tax deferred that you have to pay back. So now they're stuck. Right. Or if you get sued in that situation and I would have to move the assets out, I can't. Now you're frozen because you don't have the money to pay back to the IRS.
Oh my gosh. Yeah. Now, what happens if you have a bank loan on a property and you want to move it into a trust? Isn't that going to cause the mortgage to default?
That's a great question. No, especially for a trust, because trusts are exempt from that clause, which is, I'm air quoting again, because it's the, what is it, due on sale clause that you're talking about. So if you move your asset into a trust, it's exempt. You got the, Trust Act and St. Germain's Act. So that's the whole purpose of putting assets into trust. It's your trust. Where you really hear people concerned about this is when you transfer it into an LLC. The simple fact is, over 30 years or more, since the Great Depression, you've never seen a bank called a mortgage due because you transferred your property into your LLC. In fact, a lot of banks won't do it. Is there a clause? Yes. Has it been executed? We've never seen it. None of my over 100 attorneys have seen it. I can't ask a single attorney to find a case law where one's ever been done, because no bank is ever going to pull your file and to look for a performing note to find a reason to to find a reason to foreclose on you because you're paying your mortgage. They'll go out of business. They're just not going to do it.
Right. Yeah. They don't want.
Yeah. And so what they might do is call and say, hey, we noticed you transferred, the property over into an LLC. What's going on?
Right.
And then it's for asset protection purposes. And they say, oh, okay, thank you. And that's it. That's where the call stops.
Okay.
Where you see maybe a hiccup happen is where they noticed that you move the asset, they call, but then they notice, well, you're also not paying your mortgage.
Right.
Then obviously you're going to get foreclosed on because you're not paying your mortgage, not because you did the proper thing to protect your assets.
Yeah, of course. Yeah, it's a pretty big one. Okay, interesting. So yeah, I have talked to brokers before. They say, oh, just get the mortgage in your name and then transfer it over to an LLC. And maybe getting started, that might not be a bad strategy. But once you start investing in a larger scale with other investors, you can't be doing stuff like that, of course. But no, that's interesting. So then moving it into a trust would not cause the mortgage to become due there or default on the loan necessarily. And it's so also people with 1.2 million of net worth, that's really not that much. If you invest the right way and you make a decent income, I do have police officers, and different people and kind of hardworking everyday Americans that can build up to that level of wealth as long as they're investing wisely for a number of years.
Well, think about with them though, it takes a long time for your average cop or nurse or firefighter or school teacher to build that much. That's their retirement, that's their nest egg. And then they hope to pass something on. One lawsuit for them will completely clean them out. They're never going to retire.
Right.
They're actually more concerned and needing this level of protection than the person who has 5 million net, because I can take $1 million blow. It's going to hurt. Just think about boxing analogies. It's that left hook to the floor floating rib, that can knock you down. It's not going to knock you out, but it will knock out, the firefighter or the cop.
Yeah. Also, they might be looked at as an easier target, meaning that, hey, they don't have $20 million in the bank to fight a lawsuit, right? They may only have $100,000. You might be looking at really a, easy legal target there. The defendant or the, what would it be? The plaintiff. Yeah. So okay, that's interesting. And then as far as what your service is, if you can kind of put it in a nutshell, what exactly, how do you help people manage their estates? How does that work with you guys?
Yeah, so I don't tell you what to invest in. I don't manage your investments at all. I just protect your assets. So whatever it is, we're going to work with you. We're going to work with your CPA, your wealth managers. I just need to know what it is that you're buying and selling. And then create the structures around to protect it from doomsday scenarios. And then I'll talk with your CPA and say, okay, hey, how aggressive are we investing? What are they investing in, the type? And then we'll start figuring out what tax strategies and mitigation strategies they want to, incorporate into the planning. And that's how you have your team work together, and that's how you want it. So as you're accumulating wealth, you have to start accumulating the proper team members around, like have a good asset protection attorney, have a great CPA. You may have to change your CPA because the CPA you started with when you had nothing may not be a good investment CPA or may not be really good with real estate investing or whatever the investment class you're in. So sometimes you evolve with, a new CPA, or you could have a business CPA. They're very, very conservative. They're great for businesses, but then when you start getting aggressive with real estate, and they're not going to be as cutthroat because that's not their specialty.
Yeah.
And so you need to realize it's like a doctor. There's lots of different types of doctors, right? So you need to make sure you go to the right doctor for the right ailment to get the right treatment. And same thing with your investing world. You got to have, start accumulating the right pieces around you to get the best advice so that you can keep accelerating your wealth at a faster pace.
Yeah, no, it's good advice. And as far as, it sounds like an expensive thing, creating an offshore account, essentially, right? Creating an estate with 3 layers here. What does that, let's say you have 1.2 million in wealth and you're kind of guiding them with the estate planning. What would that cost roughly someone to complete this process with you?
That's a good question. For the whole system, for, let's just say like one LLC, a limited partnership, and a hybrid trust, generally you're talking about 31,000. It would just make it like pretty easy number. Yeah. If you were to go purely offshore, the purely offshore trust just in itself is generally around 40,000. On average, like you can see some people go 75. So I'm just gonna say on average, a purely foreign Cook Island trust, the strongest trust in the world, generally around 45. So overkill for most people. It's just not necessary. Plus, then you're gonna have to like $10,000-$12,000 a year to maintain that. It's just not it's not feasible for most people.
Right.
But you want that strength, and so that's the benefit of domesticating it. Is you do a hybrid trust. The hybrid trusts by themselves are generally around 23,000, and now you have that strength in the back pocket, cheaper to maintain, generally around $3,000 to maintain a year. You don't have to do the IRS disclosures. You don't have to do the FATCA disclosures. It's just a matter of where's your risk profile at? What's the likelihood of you actually getting sued? And then if your concern is the doomsday scenario and losing everything, with our U.S. Constitution and the legal system, the only way to actually avoid that, because at the end of the day, it's about collectability, right?
Right.
You know, like that's all I care about. Not hiding assets, which we can break down with like tax havens and fraud in a minute. You know, hiding assets, bad. Lawsuits, you know, you go to jail, hiding assets and all of that. Yeah. So what you really want is a very, very strong asset protection plan where we can fully disclose everything that you have and say, but you'll never see a penny. And you can only do that with a hybrid trust where we have the option to leverage going offshore to settle a case for a penny on the dollar.
Right, right. So you could say to the other attorney, hey, you know, we have this this card we can play, and that's going to end your client's chance of collecting on this suit, you know. But so then you try to settle for a good price.
Froze up on me a little bit there.
Yeah, I was just saying that's a good card to play, you know, to have that ability to go offshore, disclose that to the other side, and say, you know, if you push us too hard, we're going to use this option to go offshore, and you'll never collect from us. But, you know, perhaps we could settle on a reasonable amount right now and get this done with, you know.
Correct, in our reasonable amount, but as the cards shift into my favor, and my amount is generally like, here's a penny on the dollar.
Right. Yeah.
The insurance money, like there's no settlement.
Yeah.
Way you can get your judgment, but your judgment's worthless down in the Cook Islands, and then you got to jump through all those, you know, hoops down there. Just it's not worth it. No.
It's interesting, you know, it really is. Okay, that's it's very good stuff there. Yeah, unfortunately it froze up a little bit there, but no, I always enjoy talking about this this information here. It seems like, you know, to protect your assets to that level, you're talking about, you know, if someone has $1.2 million in net worth, there maybe 2 to 3% of the net worth would be spent to create this asset protection. So, you know, it's really kind of a no-brainer in my mind to protect your assets in the right way. For 2 to 3% of your asset cost makes a whole lot of sense. And quite frankly, if you're managing your assets the right way, you should probably be making about 5 to 6% a year in growth on your assets. So really half your growth from that year might go towards protecting your entire portfolio. That could be a pretty affordable option, it seems, you know?
Yeah. And I always say, you know, like for the cost of like the little kicker that you drive around in the driveway, you're going to protect over $1 million worth of net worth. And then it's a tax write-off because it's a business expense. Sure. So it's a little bit of an investment. Yes, it's also a tax, you know, benefit for you, and you get to write it off. But at the same time, I would not want to lose $1 million or more when I could have protected it for my depreciating value of my Toyota, you know, Camry and my.
Yeah. And how long does the whole process take? Let's say someone's listening to this podcast, they call you up tomorrow and they say, hey, you know what? I have that $2.2 million in net worth. It's not really structured wisely. You know, let's set up that hybrid estate you were talking about. How does that work?
Yeah, absolutely. It takes about 30 to 40 days to create everything, whether it's the LLCs, the limited partnership, and the trust, and transfer everything over. Takes about 30, 40 days. It's very efficient.
Okay.
Yeah. And then I think like one important topic, if we got time to just like break that down, is, you know, like the distinction of like tax havens, because you hear a lot of promoters talk about use this type of offshore trust and don't pay taxes. Yeah. And so, you know, if you don't mind, I think like, you know, I'd like to like just put the squadouche on that one real quick.
Yeah. Squadouche away, my friend. Let's do it. Yeah.
Yeah. So I get this question a lot. And, you know, thinking that asset protection means not paying taxes, you know, and, you know, moving and hiding. And I'm going to say that word hiding, you know, not a good word to use when we're. So you lower your taxes or not pay taxes at all. So it's just illegal, you know, and it's tax fraud. And that's when people go to jail. And I'm going to break this down, you know, further with fraudulent transfers, but I think you get the point just with this. But tax mitigation is legal, right? We all want to, pay as little as possible. That's perfectly fine.
Sure.
And it's done with your CPA and your wealth managers using the tax code in different, ways, and utilizing different investment types and creating different types of accounts like self-directed 401ks and other strategies. That's the tax code. Love it. Now, asset protection is about limiting liability and risk from lawsuits and creditors. People coming after you to take your money. It's not about hiding or moving assets to avoid paying or disclosing your assets. So what we need to understand is that offshore asset protection planning will not reduce your taxes. And that's a big point for people to take, because you hear about go create a Bahamas or Caymans or Belize trust and pay no taxes. If someone's telling you this, it's just a scam. And you hear this a lot. The scam works by a promoter, sometimes an attorney or a CPA, trying to sell the idea that if you don't have your money in the US, so your money's not based in the US, then you don't have to pay or owe taxes until you bring it back to the US, or just never bring it back.
Right.
It's completely false. The fact is that the IRS taxes you on worldwide income. It's just plain and simple. It doesn't matter where you earn your money. If you are a US citizen, the tax and you disclose. I mentioned the word FACTA disclosures. You have to disclose what's in foreign bank accounts to the IRS. You have to disclose what's in a purely foreign trust account if you're using a purely foreign trust. Those are 1035s, 1035As, mandatory by law. So the bottom line is that asset protection planning and tax planning do not go together. We can utilize the compartments. We protect what you have. Then you work with your CPA and wealth managers to decrease legally, through legal means, the taxable estate, amount that you have to pay. But anyone promising to help you, legally evade paying taxes using an offshore entity is almost certainly lying to you. And if you're involved in that scheme like this, or whether you got duped into it, unintentionally, it doesn't matter if you were a bonehead and fell for the scheme. You're the one that's liable for it and owes the money to the IRS plus the penalties, or you go to jail.
Wow.
And and go on the IRS website. It's very clear. They have it on their website. They have a page dedicated specifically to identifying, quote unquote, abusive trust tax evasion schemes. And so the IRS specifically lists, trusts being used to reduce income taxes through abusive techniques that aren't allowed by the IRS code. And so some of these, for example, are unreported income, avoiding filing returns. All the stuff that these promoters tell you that they're going to do for you are exactly what the IRS are using as cues to say, hey, no, this is a scam, and if you use it, you're going to get in trouble. Or the other one is attempting to protect transactions through bank secrecy laws in tax haven countries. So think about Bahamas, Belize, and the Cayman Islands. Those are all red flag, because they're not seen as asset protection countries like the Cook Islands. No taxes, just purely asset protection. The other ones are deemed tax havens. We're creating these trusts to hide assets, to not pay taxes. So really listen to the key words and realize what people and promoters are telling you, because it's going to have a legal effect on you.
Ah, it's amazing. Yeah, it's really interesting. And I feel like there's so much confusion out there in the tax world. Just because someone is licensed or claiming to be a tax specialist or something, you tend to follow them and be guided by them, especially if the fee is right. But that's really interesting.
Well, that's the key word you said right there. If the fee is right, people will unfortunately shop around until they find the right fee and the person who matches what they want to hear.
Well, you pay for what you get in this world, Yeah, absolutely. You cut out there, but you pay for what you get. I've hired really affordable attorneys and really affordable accountants and contractors, and you pay for what you get at the end of the day. So absolutely. And but Brian, it's been really good teaming up with you again here on another podcast. You're always a wealth of knowledge. I do actually have to run here. I have a hard stop here. But how can people get in touch with you and learn more about your services?
Yeah, just jump on my website, www.btblegal.com. I do free consultation. I'd rather have you have good advice than crappy advice or no advice. Whether we work together or not, or you can afford me or not, that's a whole different thing. Or just shoot me an email, Brian, Brian, @btblegal.com.
Very cool, Brian. Thank you so much for joining us here. And of course, to our listeners, if you are looking to put some of those assets to work that are in your estate or planning on protecting those assets better, as you're doing that, consider investing those assets in high demand apartment buildings here in New Jersey with People's Capital Group. So we've been doing this about 10 years. We help people invest in real estate here throughout New Jersey with our in-house property management company to make sure the assets are managed wisely. We're getting the best returns possible to our investors so they can take those returns, put them in estates and the right type of trusts and the right type of offshore accounts to avoid legally paying tax, of course. And the right way to do it is to team up with Brian and companies like People's Capital Group here to build that wealth and then properly store that wealth the right way and protect those assets. So, Brian, thank you so much for coming on. One more time, what's your website there?
www.btblegal.com.
Awesome. All right, my friend, have a good day. I'll talk soon.